Estamos com o Rieder da BlackRock para falar um pouquinho sobre perspectivas de renda fixa, mercado global e os novos movimentos do Fed também.
So we think the U.S. economy is growing in what will be a consistent way, in a way that will evolve over the next few years, but good growth. I mean, arguably better growth than you've seen for the last 20 years. GDP, we're running at almost 4% GDP. 4%. The average for the last 20 years has been about 1.7%, or the last 15 years has been about 1.7%. The economy is growing well. Some of the data recently has been softer. People have said maybe it's not, maybe it's going to slow. But we've had three factors that have caused a near-term slowing. Very, very cold weather, very difficult weather. One, two, we had a big strike on our ports in California. That has a very significant impact on the economy. And the third is the economy's been growing so fast for so long that you almost have to pause before you grow again. So we think near-term, the recent data has showed maybe a little bit of slowing. We think the economy is going to grow certainly for the next couple of years. So in the U.S., we've grown 1.7 million jobs in the last 6 months, 1 million in the last 3 months. And I've got an unemployment rate that is very close to what most economists would describe as full employment. So we think inflation. We think we'll see a little bit more inflation in the system than you've had historically, than you've had in the last number of months, because the economy is growing and because you're starting to get some wage increase. There's something that's very important. Technology and fuel prices are keeping inflation down. And so the inflation that we may see, a bit more inflation over the next few months, will be much lower than you've seen historically, because energy, because of cost of fuel, the cost of oil has been so much lower, and technology is changing the dynamic. We think the Fed's going to start raising rates either June or September of this year. We think we err on the side that they will move in June. We think you're starting to see some improvement in inflation. Inflationary expectations are stable, and the employment rate is incredibly strong. We think the Fed has the opportunity to move, and a 0% funds rate is too low. It doesn't make any sense. We think they're going to move soon, but we think the pace is going to be very slow. And we think they're going to maybe move 25 basis points in June, wait meeting, move another 25 basis points to a lower destination than we've had historically. So when people historic relationship has been Fed tightens, emerging markets come under extreme pressure. I don't think that has to be the case today. In fact, I don't, for two reasons. One, I think the Fed is going to be very deliberate. I think they're going to be very slow in their pace. Two, what nobody thinks about, I don't think really considers, is the leverage, the debt levels in the emerging world, and the reserve are so much lower, and the reserve bases are so much higher. And when you go back to 90 or 94 or 98 or 2002, you had economies that had a lot of leverage to them and not a lot of reserves. They didn't have any cushion. There are economies that have Mexico and India and even Brazil today that has the debt level is not, the aggregate debt level is not bad at all, and the reserve base is not bad at all. So I don't think it necessarily has to be the same phenomenon. Not to say there won't be volatility in emerging markets, there will. No doubt the dollar will continue to rise, and so some softness on some of the growth levels. But I don't think the normal, what you saw in the 90s or the early part of the last decade, I don't think that's the recipe for what has to happen this time.